Hello everyone, my name is Lara Gutierrez and I'm going to present IAS number 2, Inventories. This is my agenda. During this video, I'm going to talk about the International Accounting Standards. I will talk a brief definition of it. Also, I will talk about the inventories, that is the topic I'm going to talk about. I will do a brief definition of it too. The objective of this standard, the scope and measurement of inventories, and then I will explain the three different methods of valuing an inventory. Now I am going to explain the meaning of International Accounting Standards. International Accounting Standards are a set of common rules issued by the International Accounting Standards Board, an independent international standard setting body based in London. The goal of this standard is to make it easier to compare different businesses around the world, increase the transparency and trust in the financial reporting, also to promote global trade. This also enables investors and other market participants to make informed economic decisions about investing opportunities and risks. Universal standards also reduce reporting and regulatory costs. Now that we all know what are the international accounting standards, I am going to focus on number 2, inventories. International standard number 2, or inventories, is the term for all the finished products ready for sale or all the raw materials used to produce goods available for sale. It represents a very important asset in a business because what we have left in the inventories is one of the primary sources of revenue generation to the business. It contains the requirements on how to account most types of inventories and the subsequent recognition of the cost and expenses. The cost of the inventories includes all cost of purchase, cost of conversion, direct labor and production overhead, and other costs incurred in bringing the inventories to their present location and condition. Now I am going to explain the objective of IAS number 2. The objective is to provide orientation to determine the cost of inventories and then recognize an expense, including any write-down to net realizable value. It also provides orientation in the formulation of costs used to assign cost to inventories. Now I am going to explain the different methods of valuing an inventory. There are FIFO, LIFO, and WAC. First of all, FIFO stands out for first in, first out. It is a method for calculating the value of your inventory. In the FIFO method, the oldest products in the company's inventory are the ones that you have sold first. FIFO is one of the most used methods, but it has some advantages and also some disadvantages. The first advantage of FIFO is that it is easy to understand, universally accepted, and universally trusted. It follows the natural flow of the inventory. It produces less waste for the company. The remaining products in the inventory will be a better reflection of the market value because the products not sold are the ones that are more recent, and also it gives a higher profit. As disadvantages of FIFO, we can say that it can have a higher income tax for business to pay because the gap between cost and profit is so wider. Then we have LIFO, the last in, first out method. The most recent products added to a company's inventory have been sold first. As advantages, we can say that it can mean less corporate tax for a company to pay, and as disadvantages, that it is only permitted to use in the United States, so for the rest of the world it's not possible to use it. Then we have the last method that is called WAC. It stands for weighted average cost. This method is mainly used to assign the average cost of production of a product. It is used when the inventory items are identical to one another. Some advantages we can say about this method is that it is very easy and simple to use. But as disadvantages, we have to say that it assumes that a store sells all of the inventory simultaneously, and it does not have the sophistication that FIFO or LIFO have. Now I am going to explain a little example of a FIFO exercise. Here you can see that on February 1st, our beginning inventory is of 50 units of 200 euros per unit. On February 15, we make a purchase of another 20 units at a 250 euros per unit. On February the 22nd, we make a sale of 20 units. On March the 3rd, we make another purchase of another 10 units at 200 per unit. And finally, on March the 12th, we make another sale of 15 units. For the solution, the first thing we are going to do is recount all the units available for sale. So we add all the purchases we have made at the beginning inventory, and we have 45 units. Then we add the different sales we have made, and we have the final number of 35. So in the inventory, we have a remaining inventory of 10 units. Now we are going to calculate the cost of goods sold. For this, it is important to know that on FIFO, what we are doing is to sell the first things that we have in the inventory first. For this, when we make a sale, the things that we are selling are the things that were first in the inventory. So for the sale we make on February the 22nd, we are going to take the 50 units we had first in the inventory, and then the ones that we purchase at 250 euros. Then for the sale we make on March 12th, we are going to take the remaining units we have from the 250 euros per unit. Now we know that our cost of goods sold is of 8,000 euros, and the remaining inventory we have are 10 units at 200 euros per unit. Next, I am going to talk about the scope and the measurement of inventories. The scope is what includes this standard number 2. It includes assets ready for sale, or also called finished goods, assets in the production process for sale, work in process, and material and supplies that are consumed during the production process, raw materials. Standard number 2 excludes certain inventories from its scope. For example, work in process arising under construction contracts, also financial instruments, and biological assets related to agricultural activity and agricultural produce at the point of harvest. In the measurement of inventories, cost should include all: cost of purchase, including taxes, transport and handling, net of trade discount received; cost of conversion, including fixed and variable overheads, and also other costs incurred in bringing inventories to their present location and condition. It is important that inventory cost should not include the abnormal waste, the storage cost, the administrative overheads unrelated production, the selling cost, the foreign exchange difference arising directly on the recent acquisition of inventories involved in a foreign currency, the interest, and also the interest cost when the inventories are purchased with deferred settlement term. So here are all the references and all the information I used for the video. Thank you for your attention, and if you have any doubt, don't hesitate in asking.